All right, welcome to The Explainer. Today, we're going to follow the money. Your money, to be exact. We're going to pull back the curtain on what actually happens in that split second after you smash that buy button on your trading app. You might be surprised.
So you click buy. Where does that order actually go? I mean, you'd think it just shoots straight over to, the New York Stock Exchange or NASDAQ, right? Well, not exactly. In reality, your trade goes on this wild, complex journey. And it's a journey that has regulators and market pros. Well, they're really paying attention to it.
And at the very heart of this whole thing is something called payment for order flow, PFOF for short. Now, what is that? In simple terms, your broker can actually get paid to send your trade to a specific firm. Instead of sending your order straight to the open market, they send it to a middleman, a wholesaler, who pays them for the privilege. And right away, you can see the issue, right? It creates this potential conflict of interest, and that's exactly why regulators are digging in. So let's talk about the rules of the game here. There's this one core idea, this fundamental principle that's supposed to protect investors like you and me. But, with PFOF in the mix and all this complicated routing, it's gotten kind of murky. It's harder to tell if everyone's playing by the rules. And that's why regulators are stepping in, basically saying, hey, we need to see what's going on here. We need more transparency. And that core principle, it's called best execution. It's not just a nice idea, it's a rule. It legally requires your broker to work hard to get you the most favorable price possible, given what the market's doing at that moment. So here's the million-dollar question, the real center of this whole debate. Does PFOF, this practice of getting paid for your orders, actually help your broker get you that best price, or does it get in the way? Well, to try and get some answers, the SEC, the Securities and Exchange Commission, decided to act. They've basically supercharged their disclosure rules. They took this thing called Rule 606 and gave it a major update, all with the goal of throwing a big, bright spotlight on how brokers are really handling your trades. And what do these new rules actually do? Well, the bottom line is this. The SEC is essentially forcing brokers to open up their playbooks. They have to give you detailed reports if you ask for them, and this is key. The data has to be in a machine-readable format so analysts can actually dig in. They've got to be totally upfront about PFOF payments, rebates, the whole shebang. It's all about getting the raw data out there so we can all see the hidden incentives. Okay, so all this new data is supposed to help us settle a really big debate, a tale of two markets, you could say. On one hand, you have the argument that we need more rules, more regulation to protect people. But on the other hand, there's this idea that maybe, just maybe, the market is already policing itself pretty effectively. So which is it? Well, there's a pretty powerful argument for the market polices itself side. A group of academics, and we're talking heavy hitters here, including a former chief economist at the SEC, basically wrote to the commission and said, we've been unable to identify a substantial underlying problem to resolve. In other words, they're saying that this system is so competitive already that there might not be a big problem to fix in the first place. And they didn't just say this, they brought the data. Now, check this out. What this chart shows is something they call market discipline. Their research found that brokers are ruthless when it comes to performance. If a wholesaler starts slipping up, even just a little bit, brokers yank their business away. We're talking a 6 to almost 10% drop in orders. That is a huge incentive for these wholesalers to stay on their toes and always offer the best prices they can. So their whole point is pretty simple, right? It's this intense, cutthroat competition between the wholesalers that is the real engine of best execution, maybe even more so than any top-down regulation could ever be. Okay, that's a really strong case for how the US system works. But what happens if you just rip out the key ingredient? What if you get rid of payment for order flow altogether? Well, to see what that looks like, we just have to look across the Atlantic, where a fascinating, real-world experiment played out. So, back in 2012, regulators in the UK basically banned PFOF. And the result? It was stunning. Look at these numbers. Before the ban, only about 65% of retail trades were getting the absolute best price on the London Stock Exchange. 2 years after the ban, that number rockets up to over 90%. That's not a gradual change, that's a dramatic, almost overnight shift. And this just perfectly lays out the two different schools of thought, doesn't it? You have the US model, which says that intense competition among wholesalers is the key to getting investors a better price. Then you have the UK model, which says that nope, just get rid of the PFOF conflict of interest, and more orders will naturally find their way to the best available price. Two totally different paths to the same goal. All right, so let's bring this all back to today. What does this new world of transparency, thanks to the SEC, really mean for the future of trading? And, what does it mean for you? Honestly, the single biggest takeaway here is empowerment. It's all about the data. For the first time, you or your advisor can actually compare brokers side by side on execution quality. Analysts can finally run the numbers and try to settle this debate. Does PFOF help or hurt? And this could totally change the game, you know? It might force brokers to compete on who gets you the best price, not just who has the flashiest app or zero commission. Which brings us to the big final question. As all this new data pours in, what's it gonna show? Is it gonna prove that the US system, with all its competition, is already working great? Or is it gonna uncover some problems and maybe push us in the direction of the UK's model? We don't know the answer yet, but whatever it is, it's gonna shape how every single one of our trades is handled for years to come. And just as a reminder, this explainer is for informational purposes only. This is not financial advice.